What happens when you buy an ETF? And how does it actually track the underlying assets, like stocks or bonds, that it's supposed to mirror? Let's break it down. When you buy an ETF, you're essentially buying a small piece of fund that holds a basket of assets, like a mini portfolio. But here's the surprising part. The fund doesn't actually buy all the individual assets, at least not directly. Instead, it uses a mechanism called a creation unit to match the portfolio's performance. Think of it like a recipe. The ETF provider creates a list of ingredients or assets that make up the fund, and then uses a combination of stocks, bonds, and other securities to replicate that recipe. And here's the key part. The ETF's price is determined by the market forces of supply and demand, not just the value of the underlying assets. So, how does it all work together to track the underlying assets? That's what we'll explore in this video. By understanding the inner mechanics of an ETF, you'll gain a clearer picture of what you're actually buying when you invest in one. Vocabulary: securities, portfolio, mechanism, replicate. What happens behind the scenes when you buy or sell an ETF? And how does it affect the price you pay or receive? To understand this, let's dive into the process of creation and redemption, which is the backbone of how ETFs work. Essentially, an ETF is made up of a basket of assets, like stocks or bonds, that track a specific index or sector. When you buy an ETF, you're not directly buying those underlying assets. Instead, you're buying a share of the fund that holds them. But how does the fund itself get created, and how are its shares issued? This is where authorized participants come in. They're large financial institutions that work with the ETF provider to create and redeem ETF shares. Here's the part most people don't know. When an authorized participant wants to create new ETF shares, they assemble a basket of the underlying assets and exchange it for a block of ETF shares, typically in a large quantity, like 50,000 shares. And on the flip side, when they want to redeem shares, they return the ETF shares to the provider and receive the underlying assets back. What's often overlooked in the conversation about ETFs is the crucial role of authorized participants, typically large financial institutions like banks and investment firms, who are responsible for creating and redeeming ETF shares. Think of them like the behind-the-scenes managers of the ETF supply chain. Just as a manufacturer works with a select group of distributors to ensure their products are widely available, an ETF's issuer works with authorized participants to ensure the fund shares are liquid and trading at a fair price. Here's the part most people don't know. When you buy or sell an ETF, you're not directly interacting with the ETF itself, but rather with one of these authorized participants, who then work with the ETF's issuer to adjust the number of shares outstanding. This mechanism is what prevents large deviations from the ETF's net asset value, keeping the price you pay for ETF shares closely tied to the value of its underlying assets. And here's the surprising part. Because authorized participants are motivated to profit from small differences between the ETF's market price and its net asset value, they have a strong incentive to keep these two numbers in line, which in turn ensures the ETF's liquidity and stability. By understanding the role of authorized participants, you gain insight into the inner workings of the ETF ecosystem and how it maintains its efficiency. To learn more about how ETFs operate and the mechanisms that drive their performance, keep watching. Vocabulary: liquidity, net asset value, authorized participants, ecosystem. So, you might be wondering, how exactly does an ETF stay fair? It's not just about buying and selling shares through brokers. There's another layer to the game that keeps everything running smoothly, a process called arbitrage. Let's dive into it with a simple example. Imagine you have a box of toys, that's our ETF, and each toy has a sticker on it showing its value. This is like the net asset value, or NAV. Now, let's say someone comes along and wants to buy that box from you and give you money for it. That's what happens in the market. But here's the twist. Sometimes the price of the box might be a little higher than what the toys are actually worth. That means if you were selling the box at the sticker price, people would say, wait a minute, the toys inside aren't really worth that much, and they'd probably look for a better deal. And here's where our insiders come in. Authorized participants, APs. These are like the trusted mechanics of the ETF world. When a market price gets too high or too low compared to the NAV, these APs step in and help balance things out. Let's say the box is on sale for $10 more, then it should be based on what its toys are really worth. The APs see this as an opportunity. They buy up all those overpriced boxes from people. This is called buying shares of the ETF. And then they go to the toy store, take out all the individual toys inside their box, and sell them for the real value on their own. They're selling the underlying assets. Suddenly, they made a profit off that $10 difference. But it doesn't stop there. Now, they have boxes that are priced just right, equal to what the toys are really worth. And they can sell these fair price boxes in the market without making an extra profit or losing any. And when everyone knows this is happening, the price of those overpriced boxes starts to come down until it matches the fair price. This process of APs buying and selling keeps the ETF's price close to its NAV, ensuring that no one gets cheated, and neither do they make easy profits by manipulating prices too much. What's the real difference between an ETF and a mutual fund, and how does that impact your investment strategy? Let's break it down. Think of a mutual fund like a restaurant that only serves dinner at a fixed time every evening. You place your order before the kitchen closes, and then you get your food at the predetermined price, which is set after the kitchen is closed. In the same way, mutual funds are priced at the end of the trading day, so you get the closing price no matter when you place your order. Now, contrast that with an ETF, which is more like a deli where you can buy and sell sandwiches throughout the day. The price of the sandwich, or in this case, the ETF, fluctuates in real time based on supply and demand. This means that with an ETF, you can react quickly to changes in the market because you can buy or sell throughout the trading day. And here's the part most people don't know. This difference in trading and pricing mechanisms has significant implications for investors, especially when it comes to transparency and flexibility. You see, because ETFs are traded on exchange, their prices are constantly being updated, so you always know exactly what you're getting. Mutual funds, on the other hand, can have a lag between the time you place your order and the time the trade is executed, which can be a problem if the market is moving quickly. So, understanding the mechanics of ETFs and mutual funds can help you make more informed decisions about your investments. To learn more about how ETFs work and how you can use them in your investment strategy, be sure to subscribe to our channel for more in-depth explanations and analysis. Vocabulary: transparency, flexibility, arbitrage, liquidity. So, what's the key takeaway from our deep dive into how an ETF actually works? It's that understanding the intricacies of creation and redemption, the crucial role of authorized participants, and the mechanisms of pricing and arbitrage can give you a much clearer picture of the markets. Think of it like being able to see the invisible threads that weave together the complex tapestry of finance. By grasping how ETFs operate, you're not just learning about a financial product. You're gaining insight into the underlying dynamics of the market itself. And here's the surprising part. This knowledge can help you navigate not just ETFs, but other investment products and market phenomena as well. You'll be better equipped to make sense of financial news, to understand the implications of market movements, and to see through the noise to the underlying mechanisms that drive the world of finance. If understanding how an ETF actually works has given you a newfound appreciation for the intricacies of the financial markets, and you want to learn more about how the markets, trading, crypto, and the economy really work, then be sure to subscribe to our channel for more explainers that decode the world of finance and investing. Vocabulary: arbitrage, authorized, intricacies, mechanisms.